Are you ready?
Yes.
10 minutes for your presentation session. Start now.
Investor, are you seeking a long-term investment opportunity? Look no further than PVI, a stock that has consistently beat the market with a stable and guaranteed dividend payout plan for the next 5 years. We're here to initiate a buy recommendation for PVI with a target price of 86,800 Vietnam dong, representing a 15.12% upside. Our valuation is driven by the three main theses: our leadership position in insurance, reinsurance as the next growth engine, and investment income as the profit stabilizer. So, what about its business model? As the #1 non-life insurer in Vietnam, 94% of its revenues come from the premium. These premiums generate a float, which is then deployed into a conservatively positioned portfolio consisting of mainly deposits and bonds. This risk-averse strategy helps PVI 75% of its profits being the investment income. And essentially, the growth in premium from insurance and reinsurance activities is the main growth driver for the profit. And when we look at a larger landscape, PVI has maintained its leadership because it has positioned itself as the best industrial line insurers. This can only be achieved by its 3C competitive modes: capital, capabilities, and creditabilities, anchored by the only insurer in Vietnam to receive an A- in AM Best rating. No other competitors can replicate this in a short time, which leads us to our very first thesis.
Leveraging the 3C competitive modes, we believe that PVI continued to sustain its leading positions in the insurance segment. In the past 5 years, PVI insurance segment has grown at the pace of 16% CAGR, double the industry growth. Specifically, in the fire segment, PVI experienced an impressive growth of 70%, 5 times higher than the industry. This was driven by two main reasons. First, regulatory support. Second, PVI has the inner power to capture the market share from smaller companies. Leading forward, with a target GDP of targets of 8% and above in the next cycle, we believe that investing activities will be promoted among all sectors. In the public sectors, the investment planning is expected to grow to double at 8 trillion Vietnam dong in the next 5 years. In addition, the FDI influx capital is also expected to reach 50 billion USD by 2030. These investing activities will boost Vietnam's infrastructure system and further increase the demand for industrial insurance. PVI, with its domestic dominance in industrial products, will capture this super capex cycle. As a result, we believe that PVI continue to outpace the growth of the industry and surely reinforce top-1 market share in insurance segment.
Moving to the second thesis, we believe that reinsurance is becoming PVI's next growth engines. With the highest and continuous growth from 2021 to 2025, PVI literally dominated the domestic reinsurance market in both inward and outward reinsurance, thanks to the support system of PVN and HDI. If we look at the revenue mix, reinsurance income has accelerated since 2023, and this can be explained by the fact that it received A- rating from AM Best in the same year. We believe that this become the competitive mode for PVI to become the only insurer in Vietnam can compete in the global markets. Now, let's breaking this revenue down into smaller components. Property has always held the largest share in the PVI portfolio, and this is the product with the lowest loss ratio among the other products. Together with the underwriting and the risk management capability, this will help PVI to keep its combined ratio stabilized, even with the expansion of the inward portfolio.
Moving to the third thesis, PVI earnings will outperform driven by its investment capability. First, with the leadership position in non-life insurance, PVI have the largest investment portfolio of 17.7 trillion Vietnam dong, a scale that few companies in the industry can have. And this helped PVI receive a deposit premium 2% higher than the market. We expect that PVI investment portfolio will continue to grow faster in the next 5 years, thanks to the strong expansion of cross-written premium. Secondly, PVI investment yield is 7.0%, the highest in the industry. And by leveraging the expertise in fixed income, PVI will be able to cover the potential of the recovery of corporate bond recover, and we expect that PVI will increase its bond allocation from 2026 to receive the 9.0% of the bond, enhancing the overall return of the portfolio. And finally, PVI will be benefit from the increasing of the deposit rate in 2026 to stabilize the market liquidity. Because as currently, the economy credit growth is outpacing the deposit growth by 4.2%. And also, the loan-to-deposit rate is exceeded 100%. Therefore, the deposit yield of PVI will increase to 7.5% in 2026.
Moving to our ESG analysis, our proprietary scorecard rate PVI 8.7 out of 10. We use MSCI and FTSE framework. Environmentally, PVI has did a great job following the SASB framework for insurers, refusing to insure or invest in any exploitation enterprise, although disclosure are still an area for development. Socially, PVI excels, evidenced by its 44% CAGR in the total cost for training for employees. Corporate governance remains at the backbone for PVI industrial expansion, anchored by its ownership structure with HDI and PVN, and a strong and experienced board of directors. We fully notice the PVN divestment plan, and we view it as a non-issue as PVI has successfully reduced its reliance on the PVN ecosystem to just 12% of its revenue premiums last year. Therefore, our projections for the industrial line still remains outpace that of the larger industry.
And now, moving on to valuation, we derive a 12-month target price of 86.8 thousand VND, which is 15.12% upside from the last closing price. We use a blended approach, 50% of the residual income model and 50% from the PB multiples. So first, on an RIM basis, we calculated a shared price of 92.3 thousand VND from the four.
And PVI is planning to enter the emerging country like CLMV, which is Cambodia, Laos, Myanmar, Vietnam. Besides that, they also enter Middle East country, Africa countries. So those are the countries that PVI can have competitive in doing the pricing and doing the reinsurance for those other insurers within those countries. Thank you.
All right, time's up. Thank you, judges, and thank you,
judges.
Team
Thank you.
1. You may come back to
Global reinsurance through treaty contracts unlocks PVI new robust growth. And finally, growth is efficiently converted into higher profits. Now, PVI share price has peaked at over 100,000 VND recently. We expect this is a speculative event and therefore maintain our buy recommendation thanks to PVI's robust fundamentals. PVI has two main sources of profits. The first one comes from underwriting, and the second is from investing, which is derived from the underwriting float before any claims are paid out. This is also the common share for many insurance companies in Vietnam, in which investing accounts to the majority of profits. PVI is known for its market dominance, especially in the property and technical line. It has sustained a double-digit revenue CAGR while maintaining a below-industry average combined ratio. All in all, it stands out among its peers with its superior financial rating, its extensive client network, and a 30-year track of expertise that together forms an unmatched moat. And for its top-line growth, PVI has been aggressively winning market shares since 2020, focusing on the P&T line. And as you can see in detail, the revenue from this line, from both direct insurance and reinsurance, displays the fastest growth.
Briefing the industry, Vietnam's non-life insurance market nearly tripled the past decade thanks to the three main lines. However, the low penetration rate still indicates a huge room for expansion. For the personal line, as the income rise, car purchase and private healthcare usage will increase, support a steady demand. While on the commercial side, property and technical will be the future growth leader, supported by an asset expansions and a higher premium rate. Well, this leads to the first thesis. PVI dominance in the P&T line will drive a huge role in the direct premium. Well, from top-down view, Vietnam with a low public debt and a more effective mechanism will drive a double-digit growth in the public investment, which turns into a higher infrastructure. Second, Vietnam
to reinsure, keeping its net claim stable. Moreover, PVI also faces headwind from interest rate volatility To mitigate that, PVI has effectively shifted between long and short-term deposit depending on the interest rate environment, allowing it to capture future rate increases.
For ESG, we evaluate PVI's overall score at 3.5, higher than its peers. This score reflects PVI's active consideration for the environment from daily to strategic operations. For social, PVI deeply invests in its human resources with an extensive training program every year. It has been able to increase revenue per person, all while ensuring a gender balanced and inclusion community. For governance, PVI is strengthened by its well-versed leadership team led by President Jens Helger, along with 3 talented and seasoned CEOs. Worth noting, it is the only Vietnamese insurance company to ever receive 3 awards at the Country Awards for Excellence 2025 by Insurance Asia News. Given its superior financial rating, its impressive portfolio, PVI has successfully proven itself to be a reliable insurer, a credible reinsurer partner. And therefore, we proudly issue our buy recommendation for PVI.
Pioneering, visionary, indispensable.
Thank you for listening. Yes, and
All
now...
right. Thank you, Team 1, for your presentation. Judges, please prepare your question. All right, judges, are you ready? 10 minutes for the Q&A session starts now.
Thank you for your presentation, very interesting. So my first question would be around the business model of BVI. Basically, you can see the BVI is bearing very high growth in the past, and then you project that it's going to experience a even higher growth in the future. So what is the key success factor for that one? And then that key success factor, is it can be copied by other competitors? As you know that non-life insurance is highly competitive in the market.
Thank you very much. I will start my team's answer. Well, PVI is established with its focus on property and technical insurance. And we believe that in order to receive or to win the market share, there are a few criteria that an insurer needs to acquire. But the first thing is a strong financial base. The second is the technical know-how. And these 2 things, PVI, they have it all. They are the only insurer company with A- rating, and they have 30 years of experience. And moreover, with the HDI support, they can have access to larger database. Therefore, they can evaluate the insurance premium at a more accurate price.
Well, I want to add on to my teammate. Well, I have to admit that the capital is easy to replicate by the bank-backed non-life insurers. However, the key for the PVI here is that the A- rating, which is given from far surpass the national level, is because of the shareholder structure with more than 50% from the foreign shareholder, for foreign insurers. So PVI with the A- rating can be a specific mode that can win the bid tender that used for the complex constructions for the PNT line.
And you asked about the past success, why BVI has been able to earn this success. It's also being the fact that BVI has its root in a captive insurance from BVN, and also it's because of the governance of the company. And it will not be replicated by other insurance company. For these projects, practice is that a co-insurance. They 6 insurers insuring these projects, but BVI is not just one participating in this. BVI is the lead insurers in these projects, so it gains a lot of experience. It determines the price, and the premiums as well. So it has like better experience compared to peers.
Thank you, Tim. So I have a question about the investment yield. So can you share like the current investment yield of BVI, of the investment portfolio, and why you think the investment yield can increase to 9.1% as in your forecast?
So first of all, it is due to the macro environment because we expect that the macro environment, the interest rate will improve in the future. And secondly, it is due to the PVI's flexible capital allocation. As you can see in the high interest rate environment, it's had actively shift from short-term deposit to long-term deposit to capture that interest rate increases, and we expect that in the future with the interest rate increases, PVI will do the same thing. It will replicate its investment strategy, and we expect that it will increase its investment asset with higher allocation to long-term deposit, and therefore we expect that it can have an investment yield of 9.1%.
Okay, just a follow-up. So in your forecast, what is the average deposit rate, let's say by 2030?
Yes, I would like to take the question. We do forecast the investment yield for PVI, so we expect that the deposit income will increase by 0.5% in 2026 and 2027, and it will stay from there until 2030, and therefore we derive the investment income for PVI at around 9.1%.
Okay, thank you.
Thank you for the presentation. I think it's very interesting. I look at the valuation part. I think you explained, I think, very clearly in terms of how you actually allocate kind of the value. So I'm just trying to understand, right? You actually have, can you go to that valuation slide? There's 60% actually coming from RIM and 40% coming from PP, right? So can you explain, I think, a bit more on that? And why do you actually, select 60-40, not 50-50, right?
So first of all, we think that PVI is engaging in treaty contracts, which we believe is the alpha that the market has not yet to price in, and therefore we want to assign a higher weight to the residual income model. However, we still want to cross-check with the market. We want to see that with the improvement in ROE, how the market would price PVI. Therefore, we still assign 40% weight to the valuation, our valuation model, and that is the rationale for the weighting of our valuation model.
Great. And of that target price, right? So when you look at the value, I think, of PVI, how do you actually break down? Can you break down that value between different business? You have the direct insurance business, reinsurance business, and then I think the AM business, right? Is there kind of a high level kind of, a top-down approach in terms of the three components?
Yes, so we believe that insurance and reinsurance has one similar point, is that they all create the float for PVI to invest. So we, in our valuation model, the investment income will account for around 65 to 7% of the profit, while the float from, the insurance and reinsurance segment will account for around 35 to 30% of the profit, and that is the breakdown of our valuation model.
Great, thank you. And the last one, I think, is a bit more technical, but how do you actually account for the NCI, I think, in your valuation model, the non-control interest, because they're actually minority interest, I think, in some of the subsidiary, right?
Yes, we do account for that in our financial model. So NCI account for around 10% of the stocks. So we reduce that from our valuation model here in Australia.
Great.
So this is our net income.
Great, thank you.
There's one more question about the reinsurance business. So you say that reinsurance business is going to be the driver for the next growing stake of BVI. And then that in another slide, you can say that the retention ratio is also low. So when you got the retention ratio low, basically that you pass on the risk to other reinsurer or other people, basically. So how do you maintain competitiveness in that case when you don't take the risk, when you pass on the risk to other reinsurer? I mean that you need to compete to not only the local reinsurer, but also to the foreigner. How do you maintain competitiveness in that case?
Yeah, so the GT reinsurance is a new business that BVI just gone into 2024. So the reason why it keep like such a low retention ratio initially is because it wants to get accustomed to the market. It wants to increase experience, to gain broader data access, and to know how to assess the GT quality. So we do account into our evaluation, in the next 5 years when BVI has more experience, when it can increase the retention ratio and increase the profit from these segments.
So what important is data access, and thanks to data access, if the quality of those treaty contracts are good, the risk profile are good, we believe that it will gradually improve the retention ratio. And in Southeast Asia, we believe that PVI may be one of the only players that do global treaty contract with high quality partner. And therefore, we believe that PVI will gradually improve its retention in the future.
And we think that that would be a prudent approach. It would not be susceptible to a lot of risk. So it would be a prudent approach, a BVI, a strategic revenue strategy.
All right, time's up. Thank you, team 2. You may now come back to your seats to relax and wait for the final results. Judges, you have 5 minutes to fill in your grade form. And after this, we will have a break for 10 minutes so that our judge panel can discuss internally and complete your score.